Here we go. We are live. This is Bill Bronchick, and welcome to Webinar Wednesday. Today, we're going to talk about creating a cash cow with wraps, which is a way to do so without using tenants. And I'm going to take it very basic today because a lot of people have struggled with the high-level concept of wraps. So I am going to take it sort of piece by piece, 101, ABC, assume you know nothing. And then if you have some more questions, whether basic or advanced, as we go, please do feel free to ask them. If you are on Facebook and you have not signed up for this software, StreamYard, then you won't be able to ask questions live. I'll try to answer them later. But if you're on YouTube, I will see it and be able to answer your questions as we go. So here we go. One thing I wanted to share with you before we get into the meat of it is one of my favorite Zen proverbs, which is to know and not to do is not to know. So if as a result of learning what you learn here, you don't actually put it into practice and learn more and do it, then tune off now. You're wasting your time. And you're not wasting mine because there's other people here who are wanting to learn as well. And you can watch the replay, of course, after on YouTube or Facebook. The important concept here of a wrap is really OPM, other people's money. So we're using other people's money to create cash flow. And as a simple example, just as a parallel example, as simple as I can make it, if you open a savings account and earn 1%, and then that same lender gives you a business loan or a mortgage or whatever at 5%, the lender is earning 4 points on the spread of that with leverage. So that's the basic concept of how, that doesn't seem like a lot, 4% interest, but, on the trillions of dollars banks make every day, of course, they borrow from the Fed at very low prime rates and then lend it out at higher rates as a more complex example. But if you put money in a bank and you earn 1% and then you borrow from that same bank at 5%, they're earning a spread on the money that they borrowed from you to lend it back to you. Okay, and that's the concept of the wrap. So what is a wrap? Let's define it. A wrap, which is not a sandwich, but I put one there, it's a money wrap. It's short for wraparound. What is it wrapping around? It is an owner financing transaction. So if you're the seller, you're selling with owner financing where you're the lender and collecting payments on your equity. You might get a down payment as well, but for the most of the purchase price, you're collecting payments of principal and interest from your buyer. And in that transaction, that owner financing transaction, a loan is created that wraps around an existing mortgage lien against the property. Now, a traditional sort of owner finance or seller carry is when a seller owns a property with no mortgage, free and clear. The seller transfers title to the buyer at closing. The buyer signs a promissory note, and then a mortgage, or if you're in a deed of trust state, a deed of trust. But I use those expressions interchangeably because they're basically liens that are against the property by which the borrower pledged the property's collateral for payment on the note. And if they don't pay on the note, then the seller, in this case the lender, can foreclose and get the collateral back. So what we're doing here with a wrap is we're not paying off the underlying loan. We're going to sell it to a buyer. We're going to create a new loan that wraps around the existing loan. And if you're smart, the new loan is a bigger amount than the underlying loan. It's a higher interest rate than the underlying loan. And thus there's a spread monthly that you collect on your wraparound transaction. So for those of you who are more visual people, this is how it looks in a diagram. You've got a house here, single family, and this works on multifamily as well, or commercial. But for simple purposes, this is a simple single family detached house. And the owner of the house, who's the seller, in this case, the seller would be you, the owner of the house. You signed a note to a lender. That's the promissory note, which is I owe you, and here's how I'm going to pay it. And then you gave a mortgage or deed of trust as collateral which becomes a lien against the property. People misunderstand what a mortgage is or a deed of trust is. When you go to the bank, you don't get a mortgage, you get a loan. And then with that loan, you sign a note, and then you pledge your property as collateral. The bank doesn't own your property. You own your property. The deed is vested in your name at closing. And the lender has a lien against the property. And that lien is referred to in some states as a mortgage and in some states as a deed of trust. And for our discussion, the differences are irrelevant. The only difference is how legally each one gets foreclosed. But in any case, you signed a promissory note to a lender, and as collateral, you gave a lien against your property in the form of a mortgage or deed of trust that says, if you don't pay the note, we can get the property back through a legal process. What are the advantages to you as the seller? Well, if you're selling via owner carry terms, whether it be a free and clear property or a wrap, it's the same. The seller can get a higher price for offering terms than cash. I mean, everybody is offering a cash sale. And a cash sale doesn't mean the buyer walks in with a briefcase of money and all his cash. A buyer could go get a loan from a third-party lender, but the seller receives all cash. That's what a cash sale means. Not that the buyer pays all cash. The seller receives all cash. That's a cash deal, okay? The seller can get a higher price because if the seller says, look, you don't have to, Mr. Buyer, go to a bank. You just pay me as the lender, and you don't have to pay points or origination fees and all that junk stuff. You just pay me directly, and you don't have to qualify. I mean, the seller should qualify the buyer to some extent, credit and, income and all that. But it's not the traditional type of hoops you have to jump through to get your typical Fannie Freddie loan. So that it's attractive to a buyer, especially a buyer who's self-employed, a buyer who may have had a bankruptcy, but has really good income otherwise recently, or whatever reason, had a divorce and had damaged credit, but still is an otherwise, good, high-earning buyer and has a substantial down payment to put down. And those buyers, there's plenty of them out there, are more in number than sellers offering what we're offering. So therefore, supply demand, the seller could demand a higher price because even if the seller marks up the property, let's say it's worth objectively $300 and the seller offers the property for $320, $20,000 is not a big markup when you consider the buyer would have to spend $10,000 in closing costs and loan fees right off the bat from a third-party lender. And then another $10,000 is for the convenience of what the seller is offering, the attractiveness of what the seller is offering. Also, you get a quick sale. Again, there's a limited supply of these types of deals available. So if you sell this way, you're going to sell it in a heartbeat. And now that the market is starting to soften a little bit, if you have a property you're selling, instead of selling for all cash, you might consider selling it this way if you've got a good underlying mortgage that's long-term and a good interest rate. And we'll get to that in a minute. There's no contingency on a third-party lender. That's great, isn't it? When you sell to a buyer who's going to go out and get a loan, we got to wait for the appraisal. We got to wait for the survey. We got to wait for the loan approval and all the loan conditions. You could close an owner carry deal. I've closed them in days, but typically it's a couple of weeks at most. You also get a good return on your equity. So if you were to sell your property for all cash, whether the buyer's coming in with a briefcase of his own money or is getting it from a lender or a combination thereof, your equity that you have in the property, the difference between the sales price and what you owe, what are you going to do with that money? Well, first you're going to pay taxes on it. And then where are you going to put it? In the bank and get 1 or 2%. I mean, the stock market isn't looking that great these days. And, if you're a sophisticated investor like me, you can get good money. But if you could get, let's say you owner carried it at 6.5%, which is not that, stiff considering market rates where they are, that's a pretty good return on your equity. Plus you're getting more for the property, so you have more equity. Okay. The next thing is installment sales tax treatment, which is really good. If you buy a property and you sell it and cash out, you pay taxes. If it's less than a year, you say you buy it, fix it, sell it within less than 12 months, it's an ordinary gain. So you're paying the highest tax rate. Now, if you sell it more than 6, if you've had this for years, it's a long-term capital gain, but you're still paying 20% tax rate on your long-term capital gain, which is due next April. Okay. If you sell on an installment sale, which is in payments over 30 years, you don't receive all the principal at once. So you're only paying tax on the principal as you receive it over 30 years. Now, the interest portion is taxable in that year, but the principal portion is deferred over 30 years at the 20% rate, and it's locked in at upfront at 20%. So if they change the capital gains rates to 40%, you're locked in at 20. That's a good thing, right? And then, of course, monthly cash flow. Again, I said earlier, if you've got a property where you own, which has an underlying loan mortgage, and that's at a good interest rate, below 4, and you sell it for more than market value, and let's say it's 6.5% interest rate, you're not only making money on the spread of equity that you have plus the markup, but you're making a spread on the difference between your underlying borrowed money at 3.5 or 4 and the sales interest rate at 6.5. And now you're like the bank. You're borrowing from a bank at 4 and you're selling to a buyer and being the bank at 6.5. And you're making 2.5 points on the leveraged portion, and you're making 6.5 points on the equity portion. Let me say that again. Let's use real numbers. No, these aren't real numbers. $100,000 value house doesn't exist many places, but I'm going to keep the math simple for the example. You owe 80 at 4%. You can sell it for 100 cash, but you could probably sell it for 110 with owner carry. Okay, so let's say you take 10 down as a down payment, and you carry 100 at 6.5. You're going to make on the 20 equity you have 6.5%. And on the other 80 that's leveraged, 2.5, the difference between your mortgage 4% and then the wrap loan at 6.5. So it's making money on borrowed money. Now, there's two basic logistical ways to do this. Some of you may have heard of a wraparound mortgage, or AITD, which is an all-inclusive trust deed. In mortgage states, you use a wraparound mortgage, and in all-inclusive trust deed states, you use all-inclusive trust deeds, or AITDs. And it's a little complex here, but I'm not going to spend too much time going through it, and you might be a little confused, and that's okay, because we're rarely going to do this. The only place you really do this is Texas, because Texas has a little glitch in their law, which I'll explain in a moment. So if you own the property, you're going to deed it to the buyer at closing, subject to your first mortgage, and then take back an all-inclusive wrap, which is a second mortgage or deed of trust against the property. So using simple numbers again, $100,000 house, you sell it for 110. You take 10 down, you carry 100 at 6.5%. The underlying loan is 80,000 at 4%. Now, that second loan is all inclusive of the first, so you don't have $180,000 in liens between the two on the property after you sold it. There's only 100. Because the 100 is inclusive of the 80. That's what we call by all inclusive, okay? So when you go to pay it off, eventually this buyer is going to resell it. They don't pay 100 plus 80 to pay it off. They pay 100, and out of that 100 comes the 80 that's already there, and then net 20 to the investor, the wrap. This is a complex way to do it. You'll only do this in Texas. A simpler way to do that is what's called a wraparound land contract, which is also known as a contract for deed. And I think Louisiana, they still call it a bond for title or a bond for deed. So the concept here is like a car. When you buy a car, the lender holds on to title to the car until you pay it off, unlike with a traditional mortgage where you have the title and the lender has a lien against your title. You registered at the DMV in your name of the car, but the lender has the actual title in their file cabinet. Now, why are they holding title? They're holding title as collateral. That doesn't give them permission to drive your car. If some bank executive has title to your car for a loan in his file cabinet, can he drive your car? No, he can't. Of course he can't. Can he sleep with your sister in the back seat? Well, that depends on the interest rate. No, just kidding. So when you pay off that car loan, they give you the title, and now you own the property. I mean, the car. Likewise, with a land contract, In this case, the seller would keep title, the deed in his name, sell to the buyer on a wraparound land contract or contract for deed. The buyer makes payments to the seller monthly. The seller makes payments on his underlying loan, which is less, and he collects the spread. Okay. When the buyer is finished paying the seller off on the contract, then the seller will pay off his underlying loan and at the same time deed it over to the buyer. And this will happen if the buyer is going to resell the property or refi it. Now, even though title, the deed, stays in the seller's name, like a car, it's only for collateral. The buyer, for all intents and purposes on a land contract, is really the owner. So they can rent it, they can live there, they can improve it. They're responsible for repairs, maintenance, taxes, insurance, HOA. So this is a nice alternative if you've got properties that you don't want to deal with anymore as a landlord. And I had a client come to me recently where the city of Denver is implementing all these inspections and restrictions for landlords. And under the new code, which goes into effect in January, he would have to put about $80,000 in his house to comply. And he said, this is ridiculous. I'm just going to sell it to the tenant on a land contract. And therefore, the responsibility of ownership now goes to the buyer. It's not a lease. Even though the buyer doesn't have the deed in his name yet, the buyer's responsible for all the maintenance and improvements and keeping it up and make sure it's up to code or compliance with HOA rules, etc. The only thing a buyer can't do under a land contract is get a second mortgage or home equity line of credit because they don't have the deed in their name yet to give as collateral for that. Okay. But for all intents and purposes, and even for tax purposes, even though the title at the county shows the seller, the IRS says the buyer is the owner and can deduct mortgage interest and so forth. So for all intents and purposes, just like, regular mortgage. Okay, the buyer owns the property. So the wrap is the buyer is going to make payments to the seller for principal, interest, taxes, insurance, and the seller is going to make his underlying loan. Taxes and insurance will be the same, but the principal and interest will be lower, and then the seller gets a spread. And this is a nice way to create cash flow if you're a landlord, or if you just buy properties, fix them up, and then want to sell them this way instead of just renting them out or flipping them. It's a nice way to create nice passive long-term cash flow. Okay. Any questions people have at this time, you can post them in the chat there if you're on YouTube, and I should be able to see it. If you're on Facebook, I can't answer them live unless you signed up for the link that says sign up here on StreamYard, which is the software I'm using to broadcast here. We have a question here. It's a good one. Rod, Mr. Real Estate, handsome picture there, Rod. What makes this strategy not so attractive in a state like Florida compared to a state like Texas? Actually, it's very attractive in Florida. The only challenge is, Rod, if you give title, like in Texas, you give the deed and you take back a lien. If the buyer defaults, you have to foreclose them. But in Texas, it's a very short foreclosure period. On a contract for deed or land contract, in most states, there's a specific procedure. It says you have to give a certain amount of notice, usually 30, 60, or 90 days, depending on how much equity is in the deal. And then you throw them out. So it's more than an eviction, but it's less than a foreclosure. Now, some states like Florida don't have a particular statute, so the courts have ruled you have to foreclose them, just like a mortgage. But most buyers, to be honest, since they don't have the deed, and you do, remember the old concept of possession is 9/10 of the law. And since you have possession of the deed and they don't, you can usually say, here's some cash, sign a release, leave. Okay. So it's rare that we have to actually foreclose them. Okay. Good question, though. Okay. Thank you, Luke. I appreciate the good word. Thank you, Maria. Nice to see you today. Okay, any questions before we move on? So here's a case study. This is a condo I bought, and this is pretty low numbers. And I'll tell you, this was in the early 2000s that I did this deal, but it was a simple enough numbers I wanted to show you as a good example. This is a condo I bought from HUD in around maybe 2000, 2001. It's a 3-2. It's in a pretty good neighborhood, and it's not that old of a condo, as you can see from the picture. I bought it for 95, and at that time you could put 10,000 or 10% down as an investor, and I got a loan, and my monthly payment, just principal and interest, no taxes, no insurance, no HOA here, just principal and interest, was $700 a month. Interest rates were a little higher back then. I rented it, and my monthly payment was $700 plus taxes, plus insurance, plus HOA, which was total about $1,100 a month. And the thing rented for $1,200, $1,300, so it was okay. Well, what happened in 2003, 4, and 5? Well, everybody became a buyer and no one wanted to rent anymore. So vacancy hit close to 15% in my market, and rents dropped. So now I'm losing money every month because it was only renting for $1,000 and my payment was $1,100. I don't like that. So I decided, and the value dropped. It was originally worth about $1.25. Now it was probably worth, I don't know. It dropped to probably about 100. And the reason was because a lot of people were defaulting on their HOA payments. And HOAs, they're like government. They just keep taxing a smaller number of people more and more and more to make up for it. So the HOA dues went up, and then I went my more negative cash flow, and the values dropped. No good. So I decided to sell her on a wrap. I offered it out there as owner will carry, no bank qualifying, small down. So I found this guy. He had some cash down. He put $3,500. That's all he had, but he had his own business and he had pretty good cash flow. So I was willing to carry him, and I raised the interest rate a little bit, and I raised the price to 125. It was really only worth maybe 100. And when we went to talk about price, I said, well, he asked, what's the price? And I said, well, why don't we go by what the county says? Because the county still had it assessed at 125. Now, between you and me and, us girls here, we know that an assessed value is not always the real value. But what is the government lying? I don't know. They say 125, but that's what we agreed on. So he gave me $3,500 down, and I collected P&I $985 a month. Okay, now he's responsible now for taxes, insurance, maintenance. I don't have a management company I have to pay anymore, and HOA, because he's the buyer, not a tenant. So now I went from negative to $285 a month. Now I originally put up 10 grand, and I got 3,500 back, which means I still have 6,500 tied up in this deal. You follow me? So I have 6,500 invested with 285 a month. Let's look at my return now. From negative, I went to 285 times 12. That's my annual cash flow divided by 6,500 is 53% per annum return. So I have no maintenance. I have no property taxes. I have no HOA dues. They go up or down. Not my problem. I don't have to pay a management company. Totally passive investment. It's a real good deal. Imagine if you had like an IRA and you did a deal like this. 100,000 at 53%. After a year, it's 153. After 3 years, it's 358. After 10 years, it's over 7 million. When you earn 53% per annum on your money, you get velocity. And I'm not saying every deal is going to be that good, but I'm just trying to make an example here of how profitable a wrap can be when you work the numbers really, really well. Seller financing rules, says William. Yes, it does. Thanks. I appreciate them. Hi, Padre? Father? I'm a priest? I didn't know that. So Trend asks, what about the due on sale clause for the original loan? So I sold it, and this wrap triggers an acceleration provision on the underlying loan of mine that's called due on sale, which means the lender can call it due on sale because I've sold it. In 32 years of doing these, and I probably, between myself and all my clients and everybody I've closed these for, I probably closed 1,650 of these. I have seen zero lenders call a loan due on these. They just don't do it. Now, if I transfer title outright, the risk is a little more. Like in Texas, we do that. But I think interest rates would have to go up to like 9, 10, or 11 that before a lender is going to call due a performing loan at 4%. Does that make sense? Especially if there's not a lot of equity in the property. But if they did, what could I do? I have the deed still. Could I refi that loan? Sure, I could, with a lender who could care less. Mike asks, on a contracted deed, can the seller get liens attached against the property even though it's a contract for deed? Yeah, that's true, Mike. So if you're the buyer, that's a risk for you. In this case, I'm assuming you're the seller, okay? If you're the buyer, I would probably do the all-inclusive trust deed or wraparound mortgage and get title in your name and avoid problems like that. Okay. All right, good questions. All right. So most of you know I do have some home study courses online at legalwiz.com. And I have one specifically called How to Create a Cash Cow Using Wraparound Mortgage and Land Contracts. You can get instant access when you buy online at legalwiz.com. Just click on store and look for the Cash Cow course. It includes a PDF course manual, audio files, in MP3, online video lessons, streaming, forms and contracts, and video explanations. I actually, on this one, I sat down and screenshotted every form in the course and videotaped how to fill it out and explained how to fill it out. So it took a lot of time. I'm working on doing that for my other courses, but this one was a new one, pretty recent. So you get that benefit. If you use the discount code webinar when you check out on legalwiz.com, you get a nice little discount. I think it's 30%, and that expires this Friday. Also, I have in this course, one of my favorite things is the cash calculator. Cash, not calculator, calculator. Little play on words. What it is I paid someone to do a spreadsheet for me. And the spreadsheet asks, what did you put down when you bought it? Like, so let's say you bought it subject to from someone else, or you bought it owner financing, or you bought it with a loan, and put your own loan on it. How much did you invest to buy it? What is your underlying loan rate? What was the original balance? What is the term? And it produces a spreadsheet on the left side of all your payments. On the right side, you put in how much you sold it for, how much you got down from your buyer, and what interest rate. And it shows you side by side the amortization and how much cash flow you make and what's your annual return on your money. It's really, really cool. The cash calculator. And what's cool is you could have a mortgage, on an existing property that only has 20 years left, and you don't have to sell. If you sold it on a 30-year wrap, your last 10 years would be much more cash flow because your underlying loan is gone. But you could sell on a 20-year note, and which does what for the buyer? It increases this payment, which increases your monthly cash flow. So I show you all those things and how to negotiate that all in the course. It's one of my favorite courses. I love using this. It's pretty high level stuff when you get into it, but if you can catch this stuff for this market now that we're in, it's going to be an incredible opportunity, I think, for selling properties like this, because there's going to be so many buyers out there who need this product, i.e. your available property for sale on an owner carry wrap. So there's going to be a lot of potential buyers out there and a lot of money to be made in the next couple of years with this. So just go to legalwiz.com and click on the store and use the discount code webinar for a 30% discount. And you can use that on any of my courses there. I have almost 20 courses there, and everything from wholesaling and rentals and fix and flips and commercial and so on and so forth. So you can use that there, and that expires this Friday. So everybody, thank you for joining me live here. We're just coming up here on the half-hour mark, and that's what I want to try to keep it in small chunks every week, 30 minutes, so I don't burn myself out. And plus, I have a gig tonight with my band, and I need to rest up for that one. All right. Thank you, everyone, for joining. I appreciate it. Thanks, Mike, for the compliment about my band video. You can see that on YouTube as well. I appreciate that so much. Thanks for joining today. God bless.